What's up? Today we'll be taking a look at the best growth ETFs on the market. For each ETF, we will look at exposure strategy, portfolio composition, top holdings, cost, past performance, and analyst ratings. At the end, I'll give my own opinion. If at any point you decide you like this video, feel free to hit the like button because that's what it's there for. Also, feel free to lurk below and check out the links in the description. You can get free stocks, free crypto, other fun stuff. Without further self-promotion, let's get started. Let's first define growth investing. A growth stock is any share in a company that is expected to grow at a faster rate than the average growth of the market. These stocks typically do not pay dividends to shareholders. Instead, they tend to reinvest these earnings back into the growth of the company. These stocks tend to be more innovative as they often reinvest back into the emerging technologies that can help accelerate their growth and expand their market share. Because investors aren't receiving much income from holding these stocks, they are banking on selling at a higher price later as these companies grow and become more valuable. These stocks tend to trade with high price to earnings ratios as investors begin to price in the future growth of these companies. The danger here is that if a growth company fails to meet expectations and is already richly valued, it can experience a drastic drop down in price. Also, if the market trades down or sideways for a few years, you don't have the luxury of raking in those juicy dividends that you would get from value stocks. Side note, growth stocks tend to be a bit more tax efficient as dividends are taxed as ordinary income. So some people might keep their dividend stocks in an IRA and growth stocks in a taxable account. But while value stocks might hold up better in a bear market, growth stocks can leave value stocks in the dust in a bull market. Growth stocks can provide better potential for future return and thus tend to come with more risk than traditional value stocks. I can certainly see why younger investors would seek a little bit more risk as they have much more time ahead of them to weather the market, and then lean heavier on income-producing value stocks as they get older and start to seek more stability. I can also see why people would just own a diversified portfolio of both growth and value and just own the entire market instead of trying to pick winners. Alright, first off we have none other than Invesco's QQQ. This ETF tracks the NASDAQ 100 index, an index of the 100 largest non-financial companies listed on the NASDAQ exchange based on market cap. The Qs provide exposure to some of the most innovative companies in the world. QQQ has a whopping $180 billion in assets under management and is the second most actively traded ETF in the world. While it is not explicitly a tech ETF, it is very tech heavy. Also, see QQQM. This ETF is basically the same as QQQ, and while it has slightly lower liquidity, it has a lower expense ratio. So maybe not preferred by traders, but likely preferred by buy and hold investors. I made a more detailed video explaining the differences between QQQ and QQQM. If you're a nerd like myself, you can check it out. It's linked in the description. Let's take a look at QQQ's portfolio composition. It's almost all US based at 97%, also 97% large cap. Large caps are generally seen as safer, more stable, and established investments that can better weather negative events because of their increased size and resources. Tech lovers can rejoice. 50% of QQQ is information technology. Communication services and consumer discretionary are each under 20%. Looking at industry exposure, this ETF is heavy on software, semiconductors, interactive media, technology hardware, and internet companies. The top 10 holdings of QQQ need zero introduction. We have Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia, PayPal, and Adobe. These tech giants make up over half the weight of QQQ. Moving on to cost, QQQ will cost you 0.2% per year. Like I said, QQQM is a little cheaper at 0.15%. These are pretty low cost, but not quite as cheap as ETFs that track the S&P 500 and are down around 0.03 or 0.04. But again, those track a different index. Spread is the measure of liquidity and the cost of trading shares. Essentially the difference between the lowest ask price and the highest bid price. The lower the spread is, the lower the cost is to trade. Because QQQ is so large and liquid, it has virtually no spread costs. The smaller QQQM has a slightly higher spread of 0.02%, but that's still a tight spread. Next, let's look at tracking difference. Tracking difference shows how a product's performance compares with that of its benchmark over a stated period of time. An index is an ideal representation of the market, while an index fund is an actual implementation of it. So tracking difference is a good report card to show how well a manager is doing. It can depend on factors such as expense ratio, rebalancing costs, sampling, cash drag, security lending, and rebalancing timing. Given that fees are included, tracking difference is typically negative. The current 12-month median tracking difference for QQQ is minus 0.29%, which is not amazing, but not terrible. So we'll give QQQ a pass on that one. Let's look at performance. QQQ has been an absolute powerhouse, averaging 28% over the past 3 years, 27% over the past 5 years, and 21% over the past 10 years. This is an incredible return over such a long time period. If you invested $6,000 a year and returned 21% for 40 years, you would end up with $70 million. Obviously, this would never happen, but hey, a man can dream. Smash the like button if you would like to be invited to the party I'm throwing on my $70 million yacht that I'll have in 40 years. Also, the analysts love QQQ. It is an A rating from FactSet and 5 stars from Morningstar. Next on the list, the VanEck Vectors Semiconductor ETF SMH. This is a highly concentrated ETF that tracks the NVIS US listed Semiconductor 25 index. To be eligible for inclusion, at least 50% of the company revenues have to be in the production of semiconductors or semiconductor equipment. Semiconductors are materials that have an electrical conductivity between conductors, generally metals, and non-conductors or insulators, such as most ceramics. Semiconductors are used primarily in electronic devices, including chips, diodes, transistors, and integrated circuits. Without them, there are no smartphones, radios, TVs, computers, video games, or advanced medical diagnostic equipment. As demand for these electronics has risen, so has demand for semiconductors, and many of these companies have done very, very well. I did a video breaking down SMH and other 3 top semiconductor ETFs, so I'll link it in the description for those that are interested. SMH is 72% US based and 14% based out of Taiwan. This ETF is market cap weighted with almost 90% large cap holdings. SMH is concentrated in only 26 names. 63% of the weight is in the top 10 names. We have Taiwan Semiconductors, Nvidia, AMD, Qualcomm, Broadcom, Texas Instruments, and Intel, to name a few. Because this ETF is highly concentrated in just one subsector of the economy, there can be some risk and volatility, but with that can come some incredible returns. So let's take a look at cost. The expense ratio for SMH is 0.35%, which is not dirt cheap, but still not terrible. SMH trades with a tight spread of 0.01%. It is a 12-month median tracking difference of minus 0.52%. Moving on to performance, SMH has absolutely crushed it. It has an average return of 37% over 3 years and an average return of 35% over 5 years. SMH hasn't been around for 10 years. To get a better idea of a longer time horizon in the semiconductor market, you can look at older ETFs such as SOXX. Spoiler alert, very good returns. Also, the analysts give SMH their stamp of approval. It received an A rating from FactSet and 5 stars from Morningstar. Next up, we have FTEC, the MSCI Information Technology Index ETF by Fidelity. This ETF provides exposure to some of the most innovative, high-growth U.S. tech companies. I could just as easily have picked VGT for this, which is an ETF by Vanguard that tracks the exact same index as FTEC. However, Fidelity undercuts Vanguard's expense ratio by a few basis points, so I decided to give FTEC the nod. Usually trying to beat Vanguard on cost is like trying to win a gunfight with a knife, but Fidelity did it. I did a video micro-analyzing the difference between these two ETFs, and I'll link it in the description for those that are interested. This is mostly a large cap fund with 84% of the weight in large caps. Taking a look at sector exposure, we have 100% information technology. No surprise here. Industry exposure is more interesting. We have 35% software, technology, hardware, semiconductors, and IT services are each about around 20%. While this ETF contains over 350 holdings, almost 60% of the weight is concentrated in the top 10 names. And the top 10 names need no introduction. Apple, Microsoft, Nvidia, Visa, MasterCard, PayPal, Adobe, Salesforce, Cisco, and Intel. The most important thing to note here is that Apple and Microsoft combine to make up roughly 35% of the weight. There's certainly a concentration risk with having that much weight in just a few names. However, the two have been great companies with strong growth. But in any case, if you're going to buy this ETF, you better be a fan of Apple and Microsoft. Moving on to cost, FTEC charges a 0.08% annual expense ratio, and VGT charges a 0.1% expense ratio. Both of these are competitively low, and I personally wouldn't panic sell on my VGT for FTEC. We're splitting hairs on costs, and it would be a taxable event to switch between the two, and these ETFs tend to over or underperform each other by fluctuations of at least that much. Also, competitive spread costs for both of these. A 0.03% spread for FTEC and 0.02 for Vanguard. No surprise here that VGT trades slightly better as it is a larger fund and has a higher trading volume. But currently, FTEC has a tracking difference of minus 0.5% and VGT has a tracking difference of minus 0.25%. Moving on to performance, FTEC and VGT have returned an average of 30% over 3 and 5 year periods, with VGT doing slightly better than FTEC. And we can look to the older VGT to see an average return of 23% over 10 years. This really speaks to how strong tech and growth have been in recent years. And while we can't say which ETF will do better going forward, we can assume that there will be a small difference between the two. Looking at analyst ratings, both FTEC and VGT received an A from FactSet. Somehow VGT managed to get 5 stars from Morningstar compared to the 4 stars of FTEC. Next up, we have the Vanguard Growth ETF, VUG. It is a Vanguard ETF, so you know it is low cost and well managed. This is a passively managed ETF that tracks the CRSP US Large Cap Growth Index. This index selects its holdings based on 6 key factors: expected long-term growth in earnings per share, expected short-term growth in earnings per share, 3-year historical growth in earnings per share, 3-year historical growth in sales per share, current investment to assets ratio, and return on assets. This ETF provides low-cost exposure to many of the high-growth mega-cap tech names, as well as smaller large-cap names. Those that want higher concentration in the mega-cap tech names should check out Vanguard Mega-Cap Growth, ticker symbol MGK. It is similar to VUG, but with greater exposure to the mega-cap tech names. So looking into portfolio composition, we do still have 88% large caps and 12% mid caps names in VUG despite it being a large cap fund. So MGK may be more of a pure play on large cap growth. Looking at sector exposure, VUG is 44% information technology, 18% consumer discretionary, 16% communication services, and 8% healthcare. Looking at industry exposure, software is number 1. We also have exposure to interactive media, technology, hardware, IT services, semiconductor, and internet retail. There are 290 holdings in VUG, but the top 10 names make up 45% of the weight, and the top 10 names are basically plagiarized straight from the Qs. Apple, Microsoft, Amazon, Facebook, Google, Tesla, Nvidia, Visa, and PayPal. So sometimes you do need to check the holdings of your ETFs to make sure you aren't becoming way overexposed to just a few names, because you might not be as diversified as you think. But the other half of the weight of these ETFs do perform differently from each other. Moving on to cost, nothing to worry about with cost for VUG as it only charges a 0.04% expense ratio. That's about as good as it gets. It trades with a very tight spread of 0.01% and tracks its index very nicely with only a minus 0.09%, which is the best tracking difference we've seen on this list. All in all, a very cost-efficient ETF. Additionally, it has been a reliable performer over the years. VUG has averaged 25% over 3 years, 23% over 5 years, and 18% over 10 years. Anytime you're buying growth stocks, but even stocks in general, you're taking on some risk. But VUG could certainly be the least risky ETF on our list today. But I would still say it provides a good risk to return ratio. Sometimes newer investors only focus on returns and forget to consider how much risk they are taking to get those returns. It's all good until you get a correction, and then you learn the hard way about how much risk you were taking. As far as analyst ratings, VUG received an A from FactSet and 4 stars from Morningstar. Honestly, I'm a little triggered. I would think it would have 5 stars, but what do I know? I'm just some rando on YouTube. But this wouldn't be a growth ETF video if we didn't have an ARK Invest ETF in it. ARK Invest runs actively managed ETFs that focus on disruptive innovation. ARK is led by rockstar fund manager Cathie Wood, or Queen Cathie as they call her on Wall Street Bets. ARK believes that innovation is the key to growth and seeks to provide exposure to aggressive growth in some of the more promising areas of the economy. And while we mentioned how easy it is to have significant overlap in our ETF holdings, the ARK Invest ETFs are largely uncorrelated to traditional investment strategies and can therefore add diversification. ARK has ETFs focused on autonomous technology, next-generation internet, genomics, fintech innovation, and space exploration. However, the ETF on our list is the flagship ETF ARKK, which is basically a mix of all the innovation strategies. Let's take a look at portfolio composition. Right now, ARK is mostly US companies at 90%. Cathie Wood has been selling the Chinese stocks recently as China is in the midst of a crackdown on its companies. As far as market cap goes, ARK has more of a mid and small cap exposure, more so than the other ETFs on our list. It is 35% mid cap and 11% small cap. These smaller companies can be a bit more risky and volatile than the large caps, but they have significant greater upside potential and can bring great returns, making it worth the risk for many investors. Looking at sector exposure, we have 33% information technology, 27% healthcare, 20% communication services, and 14% consumer discretionary. Looking at industry exposure, ARK is big on software, biotechnology, IT services, entertainment, and automobiles, specifically EVs, and more specifically Tesla. Moving on to holdings, this is a concentrated ETF with only 50 holdings, and 50% of the weight is in the top 10 names. ARK is famous for being incredibly bullish on Tesla. ARK Invest has a rule that no company can be over 10%, so it's no surprise that Tesla is always maxed out at 10%. Some of the other names: Roku, Teladoc, Square, Zoom, Shopify, Coinbase, Unity Software, Twilio, and Spotify. Moving on to cost, ARK is actively managed, so you got to be prepared to pay a little bit more for the research and active trading. ARK has an annual expense ratio of 0.75%, which is high but not terrible for active management. It just depends on if you value the active management. Active managers tend to underperform passive alternatives in the long term. It is hard to do well enough to offset these higher fees and the higher trading costs. Active management also tends to be less tax efficient because of the increased buying and selling that triggers more taxable events and causes you to pay more short-term capital gains. That is why many will choose to hold actively managed ETFs in an IRA and passively manage more tax-efficient funds in a taxable account. However, the team at ARK Invest is far from the usual management team. They specialize in researching emerging technologies and focus their investments on these most innovative and high potential spaces of the economy. So if any team could defy the negative long-term statistics on active management, it would be ARK. Moving on to performance, ARK averages 40% over 3 years and 44% over 5 years. These are some incredible returns, but if you look at the graph, ARK can be a bit of a wild ride with some serious volatility. ARK had an incredible 2020, but experienced a sharp correction in 2021. ARK is easily the most risky ETF on our list, as many of these companies have incredibly rich valuations, so this presents a real downside risk if these companies are to fail to meet expectations and they're already valued so high. However, ARK invests on a 5-year time horizon, and if the ARK thesis on disruptive innovation is correct, these companies could still be incredibly undervalued based on future growth, even with their lofty current valuations. As far as analyst ratings, ARK has a B from FactSet and 5 stars from Morningstar. So what are my thoughts? I like all of these ETFs, and I own all of them. We noted specifically that QQQ and VUG have significant overlap in their holdings. More broadly, all these ETFs have overlap in the sense that they have a high percentage of the weight in information technology. Anyone that is overweight growth in tech would certainly feel the hurt if this sector were to underperform the broader market. Hence why conventional wisdom tells us to just own the broad market. Anyone that attempts to outperform may have to take on some more risk to do so, but I personally think it is worth the risk to be overweight growth in tech. This is where we see some of the most innovative and disruptive names. And I'm a firm believer that innovation is the driver of growth. What do I know? I'm just some rando on YouTube, so not financial advice. But if you found this helpful, please consider hitting the like button and subscribe for more content like this. Also consider checking out the links down below. Currently down there you can get 2 free stocks with Videvo, potentially valued up to $2,300, $30 with M1 Finance, a free stock with Robinhood, potentially valued up to $225, and up to $250 with BlockFi, where you can earn interest on your cryptocurrency. As always, none of this is to be considered financial advice. It's for entertainment purposes only. Thanks, and I'll see you in the next video.